Welcome to our deep dive into the crazy world of speculative bubbles.
Yeah, those times when markets go a little wild.
We'll be using excerpts from Edward Chancellor's book, Devil Take the Hindmost: A History of Financial Speculation.
Fascinating look at the history of speculation.
So our mission today is to kind of unpack this history,
From the tulip mania to the dot-com bubble.
to understand what drives these periods of irrational exuberance.
And most importantly, what lessons we can all learn from it.
And who knows, maybe we could even avoid some future financial fiascos.
That would be a bonus, wouldn't
No,
it?
absolutely. So let's start with a question for you. Have you ever wondered if this urge to speculate is something new?
That's a great question, and the answer might surprise you.
Oh, really?
Even in ancient Rome, we find hints of speculation.
Ancient Rome, huh?
We don't have, detailed stock market data from that period.
Okay.
But we do have accounts from writers like Cicero who mention share fluctuations.
So they were talking about the markets even back then.
Oh, yes. And Cicero warns against the risks of investing in public companies.
Interesting.
So it suggests that even in ancient times, people were already engaged in some form of speculation.
So this isn't just a modern phenomenon then?
Not at all. It seems
Okay.
like a part of human nature.
That makes me think about the Dutch tulip mania.
Ah, the classic example of speculative excess.
I mean, trading your house for a tulip bulb, that's just wild.
It really captures the imagination, doesn't it?
It does. Were they really that crazy?
Well, there's some debate about the extent of the mania, but we know that during the 1630s in the Netherlands, tulip bulbs became wildly sought after.
And the prices just went through the roof.
They soared to astronomical levels. Some bulbs even reached the value of houses.
Wow, I can't even imagine paying that much for a flower.
It's a fascinating example of how something seemingly simple can become the object of intense speculation.
It makes you wonder what drives that kind of frenzy.
Well, part of it was the structure of the market.
What do you mean?
They had these trading colleges, which were like early stock exchanges,
Oh, really?
and they were already using futures contracts.
Futures contracts in the 1600s.
It shows how many elements of modern finance have their roots in these earlier periods.
That's pretty amazing.
And here's something to consider. Even common breeder bulbs saw their prices increase 20-fold during the boom's final phase.
20-fold, that's insane.
It really highlights the power of market psychology.
You're talking about herd behavior.
Exactly. The fear of missing out can drive prices up even when the underlying asset's value might not justify it.
So people see others getting rich and they just jump on the bandwagon.
Precisely. It's like a self-fulfilling prophecy.
We see similar things happening today with meme stocks or certain cryptocurrencies.
Absolutely. That fear of missing out, that sense that everyone else is getting rich and you're being left behind, it's incredibly powerful.
But was it all just media? Or could something else like the social and political climate have played a role?
That's an insightful question. The bubonic plague was raging during that period.
Oh, right. I hadn't thought about that.
The threat of widespread death and uncertainty probably contributed to a desire for quick riches.
Like a yearning for something beautiful amidst a very dark time.
It's a reminder that markets don't exist in a vacuum. They're influenced by a complex interplay of factors.
So it's more than just numbers and charts. It's about human behavior.
Precisely. It's about our hopes, our fears, and our dreams.
It's almost like how fashion is said to reflect market sentiment.
You've heard about the hemline theory.
Yeah, the idea that shorter skirts signal a booming market.
And guess what? Back in the 1690s, there was actually a correlation between the extravagance of ladies' headdresses and the stock market.
You're kidding.
It's true. As the market soared, headdresses reached incredible heights, some over 7 feet tall.
That's hard to imagine.
It's a fascinating example of how speculation can seep into the cultural zeitgeist.
So it's not just about money, it's about how we express ourselves.
It reflects our aspirations and our anxieties.
Speaking of the 1690s, do you think the political landscape during that time had any influence on speculation?
Oh, absolutely. Look no further than the East India Company scandal of 1695.
What happened there?
Politicians caught up in the speculative frenzy engaged in rampant corruption.
So greed and power go hand in hand.
It's a reminder that speculation unchecked can have serious consequences for governance and society.
And sadly, it's not just a thing of the past.
We've seen this pattern repeat itself throughout history.
Which leads us to perhaps the most notorious example, the South Sea Bubble.
Ah, yes, the South Sea Bubble, a classic cautionary tale.
What made it so unique?
Well, one thing was the circularity of the scheme it made, valuing shares nearly impossible.
Okay, tell me more about that.
Essentially, the South Sea Company offered to take on the British government's debt.
In exchange for what?
trading rights in the South Seas.
Ah, so that's where the name comes from.
This created a frenzy for South Sea shares.
Even though the company's actual business prospects were shaky.
Exactly. It was essentially a house of cards built on speculation.
So even back then, people were buying into hype without fully understanding the fundamentals.
It seems like a tale as old as time.
You hit the nail on the head. One anonymous writer in the Flying Post at the time actually argued that the higher the stock price went, the more it was actually worth.
Can you believe that?
Talk about irrational exuberance. I've heard stories about some truly outlandish behavior during the bubble.
Oh, there are plenty of those.
Like what?
Well, there's a legend about a man running through the streets wearing nothing but his South Sea share certificates.
Wow, talk about putting all your eggs in one basket.
It speaks to the fever pitch speculation can reach.
Leading to both incredible fortunes and utter ruin.
It's a powerful image. So we've talked about ancient Rome, tulip mania, and the South Sea bubble.
Were there other examples of speculative bubbles in the 18th and 19th centuries?
Oh, there are many. And some are quite remarkable. Have you ever heard of the Poyasian loan scandal?
Poyasian loan scandal. That's a new one for me.
Well, get ready for this. It involved the sale of land rights, military commissions, and even titles of nobility.
Titles of nobility.
In a fictional Central American country called Poyas.
A fictional country. So investors were essentially buying into thin air.
Precisely. It's a testament to the power of a good story.
It's like a real-life fairy tale gone wrong.
People were so captivated by the promise of this new land that they failed to see the scam.
It makes you wonder what other fantastical schemes people have fallen for.
Well, another noteworthy episode was the South American mining mania of the 1820s.
Mining mania. What was that all about?
This one was driven by greed and a romantic vision of liberating South America from Spanish rule.
So adventure ideology and the allure of wealth all rolled into one.
And then, of course, there was the British railway mania of the 1840s.
Railways. I can see how that can lead to speculation.
This episode highlights the role of personalities in driving speculation.
Oh, really?
There was a figure named George Hudson, known as the Railway King.
He sounds like quite a character.
He amassed a fortune building and promoting railways.
So he was a visionary?
Perhaps, but his eventual downfall due to accounting fraud shows that even the most successful speculators can be blinded by their own ambition.
It's a classic tale of hubris and deceit.
The railway boom itself also sparked a wave of speculation.
So it wasn't just about one person.
New stock exchanges popped up across Britain. People clamored to buy railway shares, and of course, there was widespread corruption.
It sounds like a period of both incredible innovation and incredible risk.
It was a time of great transformation, but also great danger.
Speaking of risk, let's shift our focus to the 20th century.
A time of even greater technological advancements and dramatic shifts in the global economy.
And some of the most spectacular speculative bubbles in history.
It's a period that offers valuable lessons for us today.
Yeah.
It's amazing how these patterns of speculation just keep repeating throughout history.
Yeah, but each era kind of has its own unique flavor, right?
Oh, definitely.
Yeah.
And the 20th century, that was a period of just massive change.
Huge technological advancements, right?
And huge shifts in the global economy, too.
Oh, and of course, we can't forget about the 1929 crash.
Ah, yes, the crash that still haunts the financial world.
I mean, the Great Depression breadlines, the Dust Bowl, it was a really dark time.
But what's often overlooked is that speculative frenzy that led up to the crash.
The Roaring '20s, right?
Exactly. A time of immense change, but also immense optimism.
People thought they had it all figured out.
There was this widespread belief that America had entered a new era of permanent prosperity.
Does that sound familiar?
It does, doesn't it, that this time it's different mentality?
We hear that a lot these days.
And back then, there were a few key elements driving that belief.
Like what?
Well, people thought the Federal Reserve had somehow abolished the business cycle.
So no more recessions.
They also saw the rise of installment buying and consumer credit as a sign of endless prosperity.
Even if it meant going into debt.
And of course, there was the explosive growth of investment trusts.
Which just fueled the speculative fire even more.
It's almost like a recipe for disaster looking back.
Easy credit-blind optimism. A rush to get rich quick. It all seems so familiar.
But there was also a social dimension to this bubble.
Oh yeah, what was that?
Well, the 1920s saw a significant increase in women's participation in the stock market.
So it wasn't just the Wall Street guys.
It was everyday people, including women, trying to secure their financial future.
And maybe even strike it rich.
It's a reminder that these events are not just about numbers, they're about people's hopes and dreams.
Speaking of market crashes, what about the 1987 crash?
Ah, yes, another dramatic event that shook the global financial system.
I remember that one. It felt like the world was holding its breath.
Wondering if it would trigger another Great Depression.
But thankfully, the aftermath was relatively mild compared to 1929.
And that's what makes the 1987 crash so interesting.
How so?
It was incredibly swift, and its impact was relatively short-lived.
Why do you think that was?
There are still debates about its exact causes.
Okay.
But one contributing factor was the rise of portfolio insurance.
Portfolio insurance, what's that?
Yeah, it's a computer-driven trading strategy designed to limit losses.
Sounds like a good thing.
In theory, yes.
Yeah.
But the widespread use of portfolio insurance likely exacerbated the sell-off.
So it backfired.
You could say the automated systems triggered a cascade of selling?
So technology meant to mitigate risk actually amplified it.
It's a great example of how financial innovation can sometimes have unintended consequences.
And it makes you think about the role of technology in today's markets.
Absolutely. But let's not dwell on the past too much. We have a lot more to cover.
Right, like the junk bond market in the 1980s.
Ah, junk bonds. Now, that's an interesting story.
Tell me more.
Well, junk bonds are also known as high-yield bonds.
Okay.
They're basically debt securities issued by companies with lower credit ratings.
So they're riskier.
Exactly. But they also offer higher potential returns.
So higher risk, higher reward.
And that made them a magnet for speculators.
I can see that. And who was the mastermind behind this junk bond craze?
Well, the figure most associated with junk bonds is Michael Milken.
The junk bond king.
He made billions, but ultimately ended up in prison for securities fraud.
It's a reminder that the line between brilliance and criminality can be pretty blurry in the world of finance.
Especially when huge sums of money are involved.
Let's switch gears for a moment and talk about the Japanese asset bubble of the 1980s.
Ah, the Japanese bubble, a fascinating case study.
What made it so unique?
Well, it shows the dangers of excessive leverage and a disconnect between asset prices and underlying fundamentals.
Okay, break that down for me.
Japan in the 1980s experienced a period of just extraordinary economic growth,
The Japanese miracle.
fueled by easy credit and a surge in asset prices.
Mainly real estate and stocks.
Exactly. It's a classic bubble scenario, rapid price increases fueled by debt and speculation.
Ultimately leading to a crash.
What makes the Japanese bubble even more intriguing is the role of land.
What do you mean?
Land was almost like a quasi-currency.
Okay, I'm not sure I follow.
Well, the value of land was used as collateral for loans.
So it was like a land standard instead of gold standard.
And that fueled even more lending and inflated property prices even further.
Creating a self-reinforcing cycle of speculation.
Exactly. And during this bubble, golf club memberships became a hot commodity.
Golf club memberships?
They were seen as status symbols and investments.
How much were they going for?
At one point, millions of dollars.
Millions of dollars for a golf club membership? That's insane.
It's a prime example of how speculation can distort our perception of value.
So what happened to the bubble? Did it just keep growing forever?
Of course not. All bubbles eventually burst.
And what happened in Japan?
The bubble began to deflate in the early 1990s.
Leading to Japan's lost decade.
Exactly, a prolonged period of economic stagnation.
And the collapse of the bubble exposed a lot of problems.
Corruption, cronyism, a lack of transparency in the financial system.
It's a reminder that those things can really exacerbate the risks of speculation.
And that brings us to the rise of derivatives and hedge funds.
Ah, yes. Those complex financial instruments that can make or break the markets.
They've introduced new levels of complexity and interconnectedness to the global financial system.
And potentially amplified the risks of speculation.
One of the most dramatic examples of this is the long-term capital management collapse.
LTCM, that rings a bell.
It was a hedge fund run by some of the brightest minds in finance.
Nobel laureates, Wall Street veterans, the whole 9 yards.
They used sophisticated mathematical models and leveraged heavily.
Believing they could outsmart the market.
But their models failed to account for what economists call tail risk.
Tail risk, what's that?
Those rare but extreme events that can disrupt even the most carefully crafted strategies.
So they were betting on the market behaving in a predictable way.
And as we know, the market can be anything but predictable.
So what happened to LTCM? Did they make a killing?
Quite the opposite. In 1998, the Russian government defaulted on its debt.
Oh no.
This triggered a cascade of losses that quickly overwhelmed LTCM's highly leveraged positions.
It sounds like a disaster waiting to happen.
It was. The fund's collapse threatened to destabilize the entire financial system.
So what happened? Did the world end?
Luckily, no. It took a massive coordinated bailout orchestrated by the Federal Reserve to prevent a wider meltdown.
So they were saved at the last minute.
It's a chilling reminder that even the smartest minds can fall victim to unforeseen events.
And that the financial system is more fragile than we like to think.
It's a valuable lesson from history, a cautionary tale about the limits of human knowledge and the ever-present potential for unforeseen risks in the financial world.
Wow. It really makes you think, huh? I mean, with the global financial system being so interconnected, it makes you wonder, are we headed for another huge bubble?
It is a question that keeps a lot of people up at night, isn't it?
It does.
Yeah.
And we've seen some pretty crazy markets lately, so.
Well, while every bubble is unique, there are definitely some recurring themes that we can learn from.
Okay, so like what kind of themes?
Well, excessive leverage, for one, that's been a common thread throughout history.
Yeah, too much debt, never a good sign.
Yeah.
What other red flags should we be watching out for?
Well, another big one is irrational exuberance, that infectious optimism that drives prices way up beyond any reasonable fundamentals.
Oh yeah, like the dot-com bubble.
Exactly. People pouring money into internet companies with no earnings, sometimes even no real business plan.
It's like that fear of missing out we see on social media, but with like potentially disastrous financial consequences.
Right. It's crucial to think critically, especially in today's world where we're bombarded with information.
So don't just follow the herd, think for yourself.
And remember that narratives and stories play a huge role in fueling speculation.
Like that Poyasian loan scandal.
Exactly. People were literally buying into a fictional country.
It shows how a good story can cloud our judgment.
So a healthy dose of skepticism is always a good thing.
Especially when it comes to our hard-earned money. But I mean, speculation isn't always bad, is it?
That's true. Within reason, speculation can be a powerful force for innovation.
Okay, so like what are some examples of that?
Well, think about the early investors in railroads or the automobile industry.
They were taking a big gamble.
Some lost money, but others helped shape the world we live in today.
So it's about finding that balance between risk and reward.
Exactly. It's about embracing new ideas, but also managing risk responsibly.
So as we wrap up this deep dive into speculative bubbles, what are some key takeaways for our listeners?
Well, one of the most important is to remember that markets are cyclical.
What goes up must come down.
And the bigger the bubble, the more painful the crash.
It's like that saying, the market can stay irrational longer than you can stay solvent.
So patience and discipline are crucial.
You don't get caught up in the hype.
Another key takeaway is the importance of regulation.
Okay, so we need some rules of the game.
Right. Excessive regulation can stifle innovation, but a complete lack of oversight can create an environment ripe for fraud and abuse.
So it's about finding that sweet spot.
A framework that encourages innovation while also protecting investors and the financial system as a whole.
And of course, we can't forget about critical thinking.
Absolutely. We need to be able to question assumptions, evaluate evidence, and think for ourselves.
Right. Especially in a world where information spreads like wildfire.
It's more important than ever to be discerning.
So to sum it all up, speculation is a part of human nature.
It's been around for centuries, and it's not going away.
The key is to understand its dynamics, learn from history, and navigate the markets with wisdom and prudence.
And hopefully avoid becoming the next victim of a speculative mania.
Well said. And on that note, I think it's time to wrap up our deep dive into the world of speculative bubbles.
It's been a fascinating journey.
If you're interested in learning more, I highly recommend checking out Edward Chancellor's book, Devil Take the Hindmost.
It's a great read full of intriguing stories and valuable insights.
And it might just save you from making some costly mistakes.
It's always better to learn from the mistakes of others than to repeat them ourselves.
So stay informed, stay curious, and until next time, happy deep diving.